Okay, I believe you should be able to hear me at this point. Had a little bit of a technical glitch, but I think we are all set and ready to go. Okay, excellent. Well, thank you all for attending today's webinar. The topic of today's webinar, are you wired to be a premium seller or a premium buyer, is a little bit different than what you may be used to listening to in these trading webinars. In previous webinars, I generally will deal with a specific options strategy and talk about the ins and outs and all of the technical issues related to it. Today, I want to sort of take a step back and look at the big picture and actually look at trading from more of a subjective, psychological standpoint as opposed to more of a technical standpoint. For those of you that have not been on these webinars in the past, just a couple of words. Number one, if you have questions that you would like to ask, feel free to go ahead and type them into the chat window. And what I will do is periodically pause, go back and take a look and see if there's anything I should address at that moment, or if it would be more appropriate later, I'll make that comment. And do be aware that this webinar is being recorded, so you do have the opportunity to go to the OptionVue.com website at any point in the future, go to the archived webinars, and you'll be able to watch and listen to this one at your leisure in the future. Okay, so what I'm going to do now is to, first of all, share my screen with you. So let's take a look what I can do here. I'm going to, let's see here, share my desktop. I will click on my OptionVue application, and this is what you should be looking at. You should be looking at my OptionVue matrix, actually my OptionVue quotes display. I will pull up a matrix shortly. What I really want to get into today is, first of all, the recognition that as an options trader, you always have what I call three balls in the air at the same time. You're always subject to market movement in the underlying asset. You're subject to changes in implied volatility. In other words, option premiums will expand and contract based upon changing sentiment of the options traders. And the third variable that's always at play is beta, or time decay. Time decay on the options can work in your favor, or it can work against you. You can incur positive time decay, or your positions can incur negative time decay. It's critical to recognize that whatever option spread you put on is going to have a different sensitivity to each of those three variables. Now, with respect to trading, I've always held to the belief that there are two fundamental ways of structuring your options trades. Two fundamental ways. I call those two ways directional trading, and the other way is volatility trading. Let's take a look at what I'm really getting at. If I pull up a matrix for the crude oil futures and options, here would be an example of a directional trade with options. Let's say that we were to purchase an October 106 call with the October expiration. This option has a 46 delta. It's priced at 255. And when we look by clicking the Analyze button at the graphic analysis, this is a directional trade because you're purchasing a call option. But in addition to being a purely directional trade, it does have sensitivity to implied volatility. And you can see that by looking down beneath the graph at the Greek variables, you can see the directional component is 47 for delta, and there's a vega component, which is the sensitivity to implied volatility. That vega component is 133.9, which is represented in dollars. This option will gain $134 in premium. Its price will increase by $133 if implied volatility on this October 106 call rises by 1 percentage point. And of course, the price of that call will decrease by $134 if implied volatility decreases by 1 percentage point. If we go back to our matrix and expand this, you can see that the vega is shown here in the dialog box on the right, and you can see what the implied volatility of this option is, 21.4%. So this premium on the call option, 2.45 is the last trade, and here's the bid and the offer. In between the bid and the offer is where the market price shows of 254. That's $2,540. That price of that option will increase from $2,540 by $133 if implied volatility on the option goes from 21.4 to 22.4. So that's why I say this is not simply a directional trade, but it's a directional trade with a volatility component. You will find that anytime you purchase an option, whether it be a put or a call, you're going to have a positive vega factor. You're also going to have negative theta. You're going to have negative time decay because options are wasting assets, and the time premium on every option will decay with the passage of time. But I call this a directional trade because the primary influence on how this long call will behave is whether the market rallies or whether the market in crude oil declines. The delta is going to determine to a great degree how much this option earns in the short run. Changes in implied volatility will play a role, but a smaller role. And of course, everything is dynamic. So as time goes by, if we look at how this call will perform in 28 days, for example, 4 weeks from now, you'll find that there is a significant decrease in the projected profits to the upside because of negative time decay. In addition, the sensitivity to implied volatility, the vega factor changes with the passage of time. In this case, it becomes smaller with the passage of time. So we are involved in a dynamic environment, but this is what most people think of when they say a directional trade. You're putting on the purchase of a put or a call. Now, there's many other forms of directional trades. Let's take a look at a bull call spread, where we're not simply long the 106 call, but we're also short the 109 call. That would be a debit call spread or a bull call spread. And when you look at the graphic analysis on that, you can see that you still have positive deltas, so the trade will earn profits as the market moves higher. However, your sensitivity to time and your sensitivity to changes in implied volatility is much, much smaller than with the outright call purchase. And of course, the passage of time will also change the sensitivity to market movement, to theta, and to vega. And this is where the graphic analysis function that we're looking at right here with the multiple performance curves, this is where the OptionVue program shines, because you can see the precise sensitivity of your position to each of these different Greek variables. So this is a directional trade that a lot of people will employ. There are many other directional trades, but the idea is the primary component of profitability or loss is whether the market moves in the favorable direction or whether it moves in an unfavorable direction. The other fundamental way of trading is what I call volatility trading. Volatility trading, as opposed to directional trading. What do I mean by that? I mean putting on a position that is, in the short run, not very sensitive to market direction, but it is very sensitive to changes in option implied volatility. A perfect example of that would be the following. If we would buy the 106 call and if we would buy the 106 put in the month of October, we have created a long straddle. And this happens to be a very close to the money straddle, close to an at the money straddle. And here's what the graphic analysis on this trade looks like. We've got a delta that is very close to neutral. We've got a theta that is negative 77, but look at the Vega factor. The Vega factor is 268. That's a very big number. If implied volatility, in other words, on these October crude oil options changes by 1 percentage point, we either gain $267 if the change is an increase in IV, or we lose $267 if the change in IV is a decrease. Movement in the market certainly plays a role on how much money this trade will make or lose in the short run, but it is a smaller component compared to the implied volatility sensitivity. This is a trade where we really are banking on an increase in implied volatility, and we would like to see market movement either to the downside or the upside, because we tend to get increasing positive deltas with a rally, and this trade gets increasingly negative deltas on a decline, so the deltas can add to the profitability of the trade in the short run. We always do have this anchor of negative time decay that becomes increasingly negative with the passage of time. So anyone who puts on an at-the-money straddle of this sort is fighting the clock. You only want to put on a trade of this sort if you feel that your timing for an increase in implied volatility and your timing in terms of a move in the market is going to be pretty spot on. Because if you're wrong on either one of these and time goes by and the market doesn't move, or if time goes by and the market doesn't move enough, you're going to incur losses over a pretty wide range. You can see that in 19 days, the market has got to get below this 101.26 break even on the downside, and it's got to get above the 110.47 on the upside in order to make money. And if you happen to be wrong about implied volatility, and if implied volatility goes against you, if it declines, then the break-evens get even further away. So if you're going to be a volatility trader, this type of a position is what I call a very high octane position. It's a position that gives you the ability to put a lot of money at risk based on implied volatility and based upon your desire or expectation for market movement. Now, of course, you can do the opposite. You could be what's known as a premium seller. You could be selling the at-the-money straddle, and then you will have a performance curve that has the exact opposite look to it. Now you are sensitive to market movement, which causes losses. You're also sensitive, just like the other position was, to volatility, but now you favor a decline in implied volatility in order to make money, and you lose money if implied volatility goes up. That's what a negative Vega factor means. And the other thing, of course, is Now you have positive time decay. Now you really earn money with the passage of time, provided that the market does not move too much. Now your zone of profitability is within the break-even points, as opposed to outside of the break-even points for the premium buyer. So a person that wants to be a volatility trader has to make a choice. Should they be a seller of options, such like this trade shows, or should they be a buyer of options, like this trade shows? And the answer to that question can certainly be arrived at by doing an assessment of whether option premiums are perceived to be low or high, and whether you think they're going to move from their current level. What I've just pulled up is a price and volatility chart for crude oil, where the blue line represents implied volatility, and you can see how that has been moving around over time, moving around quite a bit. It's been as high as about 27% in the middle of April. Right now it happens to be 21%, but it's been chopping around quite a bit. So you can then make a determination about whether you think implied volatility is going to rise or fall or stay the same, and you can make that determination by looking at statistical volatility, the brown line. You can make that determination by looking at where implied volatility has been in the past. So when I click the letter V in the lower left corner of the screen, you can get different time periods all the way as long as 6 years for different measures of implied volatility. And you can see that the current implied volatility is quite low compared to where it's been over the last 1.5, 3 years, 4.5, even 6 years. So you can make determinations on whether you feel implied volatility is going to go up or down, and then you can structure a trade, whether it be a trade of this sort, where you're selling or buying at the money straddles, or you can do other types of positions where you may want to do selling of an out-of-the-money call, the sale of an out-of-the-money put, and then you're purchasing insurance further away on both ends so that you have what would be known as an iron condor. And the iron condor also has a volatility component that happens to be negative, but it's much smaller in magnitude than the volatility component on the at-the-money straddle. But it is a delta neutral position. It still is a volatility trade where you will find that with the passage of time, your volatility component stays fairly constant, but it does change as the market moves. And you have a different risk dynamic. You have limited risk rather than open-ended risk on the short straddle. Many different types of trades, and we're not going to even get into all the different trade types, but the point I really want to make here is that when you are putting a trade together and deciding whether you want to forecast implied volatility going up or going down, you are making a decision as to whether you want to be a premium buyer or a premium seller. This particular trade is a premium selling position because the performance curves have a concave downward look to them, which means you earn positive time decay, but you are sensitive to market movement in both directions. And it also has a negative vega, which means you favor a decline in implied volatility. And if you are doing a trade like this long straddle, you are a premium buyer. You're a premium buyer not just because you're buying the options on both sides, but you are incurring negative time decay, and you are very much subject to a volatility increase. You want volatility to increase. Now, when I talk about the psychological differences between being a premium buyer and a premium seller, this is really the part that I really want to delve into. And let me just check here. Okay, I do see there was one question. Will this webinar be recorded and archived for later viewing? Yes, it will be, and you will be able to access it on the OptionVue.com website. On the very first page, it will say Archived Webinars. You'll be able to click that and identify the webinar you want to watch. Okay, so here's where we get into the psychological impacts. Because what I'm really talking about, what I've just shown you here, is you can do an analysis in a very objective way by using OptionVue's price and volatility chart, making comparisons of implied to statistical, implied current reading to implied previous readings, the relationship of market movement in relation to what implied volatility does. And you can draw your own conclusions on whether you feel the blue implied volatility line is going to go up or go down, and put on the trade that benefits accordingly. If you think implied is going to go down, you want a negative Vega factor. If you think implied is going to go up, you want to have a positive Vega factor, like this long strangle or this long straddle. But of course, here's the part I want to get at. When you start looking at all of these curves, regardless of the type of position you put on, you're going to find that your curve is going to have performance lines that either are concave downward, like this calendar spread, or they're going to have concave downward lines like this iron condor, or they're going to have concave lines upwards, like this long straddle. And that tells you right away whether you're benefiting from market movement or from the lack of market movement. And so, in other words, do you as a trader have the intestinal fortitude or the stomach to occasionally incur a large loss? And when I say occasionally incur a large loss, I mean a large loss that could happen in like one day, very quickly. If that's something that you want to definitely rule out of the picture, if that's the case, then you never want to do a trade that has concave downward performance curves, because it's only a matter of time before you put on one of these types of trades, and what's going to happen is the market's going to make a big move in one direction or the other, and you're going to lose money right away or maybe in a week's time, and you're going to lose maybe more money than you would really feel comfortable with, because you have no control over the magnitude and or the direction that the underlying commodity or stock is going to move in. You have no control over that whatsoever. When you put on these concave downward, or what I call negative concave performance curves, premium short, premium selling positions, you have to be willing to occasionally incur a large, rapid loss. That's the nature of these positions. You can adjust these positions if the market moves more gradually, and you can try to mitigate the loss to some degree, but it's inevitable that you will have a large loss that's incurred, especially if you're a more aggressive premium seller where you have sharper concave downward curves. Then the losses can be very large with a big move in the market. So if you don't have the stomach for that, then you don't want to be a premium seller. Then you have to be a premium buyer. You have to be a premium buyer. You have to be willing to have a position that has concave upward lines to it. Concave upward lines. Here would be an example. Once again, if we buy the 106 call and we sell, let's say, the 110 call, and if we do the same thing with the puts, if we buy, let's say, the 105 put, and we sell further out of the money, let's say this put here, the 100.5, now what we have is performance curves that have a smile look to them. It's an upward, concave upward look to them. These are positions that benefit from market movement. You're never going to have a sudden large loss on a trade of this sort. The only way you're going to have a loss, you're going to lose money slowly by holding this trade over time, having negative time decay eat away at the value of your position. And of course, you may have losses in excess of what the negative time decay shows over time if implied volatility moves the wrong way. In this case, if implied volatility decreases. So when you have these upwardly sloping performance curves, you basically are putting on a trade that I call is playing offense. Playing offense. You're looking for something big to happen. You want to be aggressive. You want the market to move. You want implied volatility to increase. But you're willing to incur small losses over time while you're waiting for something to happen and waiting to take advantage of that move in the market or that spike higher in implied volatility. So, in other words, if you don't mind watching your positions lose from negative time decay while you wait for turbulence in the market to occur, turbulence in the underlying and turbulence with implied volatility spiking higher, then this is the type of trade you want to do. You want to be a premium buyer with the positive concave performance curves. This is a reverse iron condor that provides that. Certainly a long straddle or a long strangle will give you that type of a position. You have the concave upward, but of course when all you do is buy options and you don't sell anything against it, then you have a lot of negative time decay and a lot of vega. So this is a much riskier position than the one we just looked at, where your negative time decay and your positive beta are smaller numbers. You have many choices here. There are other ways of putting on positions with positive curvature. What we're really talking about when you have a smile of this sort with the performance curves is you're looking at gamma that is positive. Positive gamma is where you benefit, where your deltas get increasingly long on the upside when the market rallies. Your deltas get increasingly short on the downside when you have positive gamma. And when you have negative gamma, like on this trade here, what you have is a position where when the market rallies, your deltas get increasingly short. That's why you lose money. When the market declines, your deltas get increasingly long and you lose money. So you really want to look at the concaveness of your performance curves to know whether you are going to be vulnerable to sharp moves in the market for losses, or you're going to benefit from sharp moves in the market. So that's why I really keep focusing on the psychological disposition that each of you have as a trader. And that's really a very important decision to be made. You don't want to necessarily make your choices of trades to do only on objective criteria about undervalued options and overvalued options. You really want to use the graphic analysis function in OptionVue and recognize whether the degree of loss that is possible with a sharp move on a position of this sort is something that you can live with. And if it's something that you're always going to be nervous about and you're not going to be able to sleep at night, then you don't want to do any trades that have these positive time decay, negative performance curves. You only want to do trades that will give you the ability to benefit from market movement, things like reverse iron condors or long strangles and long straddles. And that's very important because in the years that I have been trading and all of the people that I have talked to and been a broker with, oftentimes the difference between success and failure comes down to matching the types of trades with the person's psychological makeup. And so we're talking not just about the amount of money that's put into any given trade, but the nature of how that trade performs. It's the nature of how that trade performs and how you as an individual feel about losses. Are you okay with an occasional large loss in order to have small profits build over time? Or are you on the opposite end okay with frequent small losses with the expectation that you're going to have a big profit? And that's really what we're looking at here. If you're okay with losing money slowly because of negative time decay, but you really expect that sometime in the next 19 days, the market's going to make at least a $6 rally or a $6 sell-off, then you'll be okay. Then you'll make, make a profit. These are the types of considerations you really want to think about over and above what you may have thought about when you tried to establish your position in the first place. Okay, let's see here. There's a question. Do the futures typically have an implied volatility skew between calls and puts, like the stock indexes, which do and don't, for example? Do any typically show no skew? Yes. The answer to your question is futures markets are very different than equity markets in the sense of volatility skew. And you really need to kind of go through each of the futures markets and examine what their characteristics are. So, for example, let me give you an example here. With crude oil, if I go into the model volatility screen, what you will find here is a lot of information. This is a huge resource. There's a horizontal skew. There is a vertical skew. Let's look at the vertical skew to begin with. The vertical skew is something that if you were to look at the October options and you look at the skew graph for the October options, calls and the puts are shown separately. You can see that there's a smile to it. There's a smile to it, which is telling us that the out-of-the-money puts trade at a higher implied volatility than the at-the-money puts, and it's also telling us that the out-of-the-money calls tend to trade at a higher implied volatility than the at-the-money calls. That is a volatility smile for both puts and calls. If we were to look at vertical skews in other markets, sometimes they're flat. They don't have that smile to them. They might even have a possibility of a frown. It might be that it's a flat skew. So the vertical skew basically is looking at the implied volatility on each of the options in the same month and comparing the out-of-the-monies with the at-the-monies and the in-the-monies with the at-the-monies. But there's also a horizontal skew. And OptionVue just recently came up with this major enhancement to the program whereby you can see how implied volatility changes based upon whether you're looking at front-month options that expire in 30 days, options that expire in 2 months and 60 days, 90 days, even all the way out to 2 years. And you can see what those volatilities are right here on this page. And most significantly, you can see how those volatilities will change as the market moves lower or as the market moves higher. These are all empirical calculations that OptionVue has made going backwards in time so that you can get a feel for how each commodity has its own unique fingerprint in terms of changes in put and call implied volatility across different expiration months as the market changes. So it's very sophisticated. In addition, you have what is known as a CEV factor, constant elasticity of volatility, for the 30, 60, 90-day, 1-year, and 2-year options. And the CEV factor is really the way of expressing whether implied volatility goes up when the market declines, which it does in this case. You can see that all of these implied volatility lines on the bottom of the screen, as the market in crude oil falls, they rise. And that's why the CEV factor is less than 1. If it's less than 1.0, it's telling you that there is an inverse relationship. When the futures decline, implied volatility goes up. And it tells you that when the futures rally, implied volatility goes down. So there's all kinds of volatility information that is unique to each commodity. So we're looking at crude oil. If I were to close crude oil and if I were to go to a different market like silver and pull up the matrix on silver and go to the model volatility screen, it looks as though silver also has CEVs less than 1. And when we look at the vertical skew on silver options, we have a very pronounced smile where the out-of-the-money options for puts and calls trade at much higher implied volatility than the at-the-monies. And let's look at a different market. Let's look at the Japanese yen and go to the model volatility screen. Now you'll notice that we have pretty flat curves. Whether the yen rallies or declines, implied volatility holds pretty steady. The CEV is a little bit more than 1, which tells us that implied volatility tends to rise a little bit when the yen rallies. And with respect to a vertical skew, let's take a look at what that looks like. It has a little bit of a smile to it. So OptionVue is a tremendous tool. You can go to any particular commodity or futures contract or even stock for that matter and get its unique fingerprint for vertical and horizontal skews on implied volatility. Let's see here. If you are a premium buyer, the probabilities are against you. That's a comment that we have from one individual here. And that is absolutely true with a lot of provisos. If you are a premium buyer, the probabilities are against you. So here's an example of a premium buying position. We're long a strangle. When we look at OptionVue's analysis and we look at different timelines, take a look at the left side of the screen. It says current bell results, probability of profit, 37% in 19 days. Probability of profit, 36% in 9 days. In 28 days, the probability of profit, 37% again. So it's telling us that if you are a premium buyer, you do have less than a 50% probability of making money. However, that is assuming that the holding period, in this case 28 days or 19 days, whatever holding period we want to look at, it's assuming that between today and that holding period, implied volatility doesn't change. If implied volatility moves the way we want it to, let's say it moves favorably, it increases by 2 percentage points, well, then notice what happens. In 9 days, now we have a probability of profit that's greater than 50%. In 19 days, it falls below 50%, but a lot depends on whether implied volatility moves in the direction that we desire, and it also depends upon whether our assumption about statistical volatility, the movement in the market itself, is going to change from what implied volatility happens to be right now, or statistical volatility happens to be right now. So there are a lot of assumptions that go into the probability of profit computation, but just because a mathematical model will always show premium long positions have less than a 50% probability of profit, it does not mean that it is an undesirable position, because there are other factors at play that may work in your favor. The market may trend, and that will cause the position to make money. The statistical volatility may turn out to be greater than what statistical volatility has been in the recent past. That will tend to make the position earn money. So you never want to discard or throw away the desirability of being a premium buyer, because oftentimes only premium buyers are the ones that make money, especially when the markets get turbulent and get quite volatile, and implied volatility rises along with it. Okay, let's see here. Let me close the crude oil position here. And try to express one more time the relationship of these various parameters, namely the following. When you are a premium buyer, you are basically putting on a position. It is vega positive. It benefits when IV goes up. You have positive gamma. You benefit when the market makes a big move up or down. So you are hoping that shortly after you put on your position, volatility will increase, the market will move, and the way that you will get hurt is if you're wrong on the timing and time goes by, so that you incur negative time decay while you're waiting for one of those two things to happen. Conversely, when you are a premium seller, you are basically playing defense. What do I mean by playing defense? You always have to be aware of the fact that you are going to be vulnerable to large and rapid losses if the market moves a lot right after you put your position on. You're hoping that everybody goes to sleep, that time goes by, that implied volatility drops because people are complacent and they don't have much in the way of expectations for moves in the market. But you have to be vigilant, because if you're wrong and something happens and the market makes a big move, and that move is accompanied by rising implied volatility, you're going to have a very, very big loss. So you psychologically have to be prepared for that, or you have to just make the conscious decision in advance. I'm never going to be a premium seller. I'm only going to be a premium buyer. I'm willing to undergo, as a premium buyer, the water torture of negative time decay that eats away at my positions. But I'm going to be a premium buyer because I know eventually I'm going to get the timing right, and I'm going to get a good move in the market, and I'm going to make a lot of money, and it will offset the losses that I may have incurred on previous positions where I was wrong about my timing. So once again, this is where the OptionVue graphic analyses really come into play, and they allow you to see exactly how your sensitivities to those variables really play out. Now, there is a hybrid position. A hybrid position is a position that I feel is an advantageous type of a way of trading. It's not really directional trading. It's not really implied volatility trading. It's more what I call time trading. Time trading. And what do I mean by that? I mean a trade that earns positive time decay, is not very sensitive to market movement, and is also not very sensitive to changes in implied volatility. That is a trade that is a position as follows. Let's work with crude oil one more time, and let's put on the following trade. Let's say that we sell the at-the-money 106 call, and we sell the at-the-money 106 put. Now, let's say that we make an iron butterfly out of this, where we purchase the 110 call, and we purchase the 102 put. This is an iron butterfly. It looks like this. It does have negative gamma, so it is a premium short position, and you can really see that as you look at the projections going forward in time, because it is definitely concave negative on the performance curves, and it does have a negative Vega factor, and it does have positive time decay. But now watch what happens if you do the exact opposite position in the month of November. You use the very same strikes, but you change the signs on all of these trades. What we've done here then is in the month of November, we've put on a reverse iron butterfly. And when you look at all of these positions combined, what do you have? You have a position that has a very, very flat looking performance curve starting out. A big sharp move one way or the other is going to have very little P&L impact on you. As time goes on, you can see there is some negative curvature here. You do have a negative gamma, but by that time, this trade, will have earned profits over a certain range. You can see where the break-evens are on the downside or the upside. More importantly, starting with the T+0 line, the Vega factor, the sensitivity to implied volatility is virtually non-existent, and it stays very, very small, even 28 days into the future. So this is a trade where you don't even have to anticipate or forecast implied volatility. But what you do is you benefit from positive time decay that starts out and builds greater and greater with the passage of time. You can see it's up to the $50-some level after 28 days. It has very low margin, so the potential return on margin can be quite high over a wide range. And this type of a trade definitely, to a great degree, eliminates some of the psychological type of considerations that I was telling you about with being a premium buyer or a premium seller. Because what we've done here is we've combined being a premium seller in the month of October with being a premium buyer in the month of November. Consequently, we take away the sensitivity of the overall trade to implied volatility. Now, I've just simply structured it with at-the-money options, an at-the-money iron condor that is in a front month and a reverse at-the-money iron condor in a deferred month. There's many other ways of doing it where you may even want to do the following. Start off with an out-of-the-money credit spread with calls. You start off with an out-of-the-money credit spread with puts, something like this. So now you have not an iron butterfly, but you have an iron condor. And now if you do the same thing with opposite buys and sells in the deferred month of November, and you look at this graph, now you have a position that has similar characteristics to the one we just looked at. It has actually greater profit potential over a wider range. Greater dollars of profit over a wider range. So you really want to use the OptionVue software to experiment with structuring trades using different strike prices so that you can really dial in on where you want your sensitivities to be. You're never going to be sensitive to implied volatility. You're always going to benefit from beta in this case. And if you didn't want this trade to start off delta neutral, you could structure this so that you shift the trade to be either delta positive or negative. And you do that by simply changing what strike prices you're using. So let's say that we, on this position here, let's do this. I'm going to just pick out some strikes like this, and let's see here. Now I'm going to get rid of these, and I will do the opposite here. So now I'm starting off with a trade that is biased a little bit to the downside starting off. That way we have a head start on anticipated market direction if we think the market's going to go down. So our break-evens now will be closer on the right and further away on the left. So there is tremendous flexibility here on how you would structure it. But quite honestly, unless you want to be a purely directional trader, or unless you want to be truly a volatility trader that's trying to forecast where the blue implied volatility line is going to go over the holding period of the trade, you have the choice of doing a trade of this sort where you take the implied volatility factor out of the equation and you earn positive time decay with very little sensitivity to market movement. And you can start out neutral, or you can start out biased a little bit delta short like this. You can do it biased delta long, however you wish. This is a very, very powerful trading technique. It's what I call vertical swap trading or calendar swap trading. And you will find some information about this on my personal website, which happens to be theaceprogram.com, theaceprogram.com. And, you know, I would encourage all of you to check this trade strategy out, because it does open up another avenue for you without necessarily exposing yourself to wide swings in implied volatility or exposing yourself to extreme vulnerability based on market movement. It has those big advantages. All right, let's see what other questions may have come up. Do you adjust these or just close if the market goes against you? Well, this particular strategy that we're looking at here, this strategy is definitely adjustable, because let's say that you had this strategy on and the market were to start rallying and your position becomes increasingly delta short and it is losing money. Well, it's easy to adjust this trade, because all we really need to do is to acquire positive deltas to reduce our negative delta exposure, and we can obtain those positive deltas in any number of ways. One way would be to do a credit put spread. So we, for example, in the front month of October, we could purchase to close the 100 put, buy that and it goes away, and then we could sell to open the 101 put. That's a credit put spread, and then the position would be less delta short at this level. Perhaps because we were 9 delta short, now we'd be 6 delta short. We could also go ahead and buy the 108 call to close and sell the 109 call to close. So when you do the bull call spread and the bull put spread together, now you really have gotten your position back to neutral, and you've opened up a wider zone of profitability on the upside as time goes on. There are many other ways of adjusting, but you can adjust these trades. They definitely are adjustable. There's more information about adjusting these vertical swap trades on the webinars that I have on my site. Okay, let's see if there's anything else here. I don't believe there is. So if you do have questions that come up after you review this recording, feel free to send me an email message. You can reach me at my email, which is OWL, owl, like the bird, at west.net. I'd be happy to answer any questions that you may have about this. Thank you all for attending today's webinar. I encourage you to check back periodically to see what other webinars OptionVue is hosting, and I'm sure that there will be a lot of valuable information you'll be able to glean. Thank you, everybody.